What's going on, everybody? My name is Ronnie Withager, and I want to jump on this webinar for you today to talk about year-end tax planning strategies. Year-end tax planning is really where I feel like CPA's value is really noticeable. I mean, a lot of people are going to think about tax preparation and business consulting, and that stuff is important. But where we really can kind of help people get their ducks in a row is through tax planning and spending time with the client base, really helping people understand what they are doing well, what they're not doing, and just giving them information. So for those of you who have worked with me for years, you know that I'm really aggressive about tax planning at the end of the year, and I do a lot of calls with people, and so I want to just kind of give a foundational webinar for you today and make sure that you come to our phone call prepared is really what I'm aiming for. So I've got a little agenda. I'm going to talk to you guys about the tax planning process and what I'm going to be doing through that for you guys. We're just going to talk a little bit about political ramifications and the current landscape that's kind of out there right now. We'll talk about business tax planning ideas that are out there, and different things that you should be doing to be compliant, and then we'll kind of circle into personal tax ideas that could be used this year. So hopefully I'm going to go through a laundry list of things. I'm not going to really break down everything in a lot of detail, but I want to give you guys enough to where you may say to yourself, yeah, that sort of piques my interest, and that's something that I'm going to want to talk to Ronnie about. So over the next 6 weeks, I'll be doing a lot of phone calls, and I'll be doing a lot of number crunching kind of behind the scenes, kind of making sure that there's no big surprises come March or April. It seems like every single year I'll have somebody that's like, wow, I wasn't expecting that, or I might get a new client that just says, hey, my CPA really didn't have time to go through things with me, and I'm really shocked by the numbers. That's one of my least favorite things. As a accountant personality, we don't really like surprises. We kind of like everything in a box a certain way. So I want to make sure that we're kind of proactive and not reactive towards our tax situations. When we go through all the different things that we're going to go through today, I think that you're just going to get some foundational stuff that's going to pique your interest. That way, when we jump on our call, you can say, hey, Ronnie, I really liked what you were saying about this, and that sounds like something we would want to do. That way, I don't have to kind of sift through 20 ideas, with a couple hundred people. So that's why I really like to do this, and I hope you'll take the time to listen to what I'm going to be talking about today. In the meantime, between now and when we do your phone call, I would love for you guys to kind of be updating your bookkeeping, updating your numbers, kind of understanding what your numbers might be. If you have particular investments or something along those lines, maybe getting at least an estimate of what those amounts might come out to be for 2021. That way we're not kind of guessing. Now, there might be some things that you don't know, and we may have to estimate on some things, but usually when we're doing these tax planning calculations, we're really just trying to get in the ballpark so that we can see if it's going to be worth it to implement some ideas. So what I like to do is just get on the phone, kind of do some discussion. What I like to do to start is estimate what your taxes would be if we did not implement any of the ideas that we're talking about today. That way you have a baseline. This is the worst case scenario that I'm going to be looking at for taxes. But after we go through kind of what that number is, then we can work through the ideas that we might be able to implement to reduce that tax burden. And depending on what tax bracket you're in, you may be more aggressive about tax planning ideas, or depending on cash flow, you may be less aggressive about it. So it really just depends. And I will say that usually when it comes to reducing your tax burden, it usually comes to spending some money. So You'll end up seeing how that works as we go through some of this, but I really just wanted to kind of try to give you that foundational piece. Now we have about 30 to 45 days to implement this stuff. A lot of times I'll get people that are like really kind of antsy, and they're like, oh my goodness, it's the end of the year, we've got to do something. I have some people that will call me for tax planning on like December 27th, and will say, what do I need to do before the end of the year? And we've done planning like that. I don't always suggest that because usually that's during vacation time, but if that's you, I'll do everything I can to help you make sure. But we have a lot of time right now. We're, like I said, a solid month of implementation. So don't be nervous about that. All right, let's start out with some business tax ideas. A lot of people like to say, what can I do to reinvest in my business? What, and get some kind of tax deduction. So the first thing I'm going to talk about is fixed asset purchasing. A lot of people like to purchase vehicles. They may have to purchase computer equipment, software. They may have to purchase medical equipment. That's a big one. And one of the things that's still in place is 100% bonus depreciation. When you purchase let's just say an x-ray machine for your medical practice, and it costs $80,000. If you are in a let's just say you pay 40% taxes. When you spend $80,000 on an x-ray machine, that saves you $32,000 in taxes this year. So bonus depreciation is one of my most common ones that we'll have people taking advantage of. And really, I think a lot of time comes down to more expensive type of medical equipment, more expensive computer type equipment, or possibly some leasehold improvement stuff on buildings and vehicles. So I'll get a lot of people who want to buy a large truck before the end of the year, one that's over 6,000 pounds. And so there's some opportunity to take advantage of what's called bonus depreciation. But again, that usually entails spending some money, but that one's still alive and well for right now. The next one I'm going to talk about is prepaying expenses or deferring revenue. Now, this is one that kind of can go back and forth, but one of the things that you may do is you may wait to invoice some of your clients. If you've had a big 2021 and you want to push off some of that income into 2022, you can defer your revenue and maybe push off some of your invoicing. Or something that a lot of people have done with me is they want to prepay their tax prep fees for the next year so that they can get a deduction for it. If you're a guy like me, I might be like, hey, I'm not going to let you prepay your invoices this year because I might be trying to defer revenue. But deferring revenue is one, and then, like I mentioned, prepaying some expenses. If you have expenses that you're going to pay in the upcoming year, you may want to pay those expenses. I have clients who spend a lot of money on advertising, and they know they're going to do advertising every year, so they spend money on advertising at the end of every year for the upcoming year. So, there's a way to prepay some of your expenses, spend some of your income down, and reduce your tax liability and kind of push that off. But you may have had a small 2021 though, and be like, Ronnie, why would I want to do that? If you had a rough 2021 because COVID kind of had slowed your business a bit, by all means, you may end up saying, I want to collect revenue now because, next year is going to be a much bigger year. So that's another thing there. All right, let's talk about having an accountable plan. An accountable plan is it's supposed to be a written document that outlines some of the reimbursements that you're going to get for personal expenses that you're paying for. So, you have a document that says, I'm going to reimburse from my business my telephone, my car mileage, and any meals that I paid for personally that were for business use, and then my home office, for example. You may have that detailed on some kind of official paper document that you keep internally and say, this is my accountable plan that I will reimburse myself and my employees for, in the case where we're going to use those. So, you may be on a family cell phone plan, for example, and you've got that coming out of the personal account, but it's $100 a month. Well, let your business reimburse you for 12 months because you use your telephone for business. So, send $1,200 from your business to you personally to reimburse yourself through that accountable plan. So we'll want to make sure that you're kind of doing that. You're making sure that we're catching some of those expenses that you're paying for personally that should be ordinary and necessary business expenses, so that you're catching that kind of stuff. So anyways, we'll kind of make sure that your accountable plans up to date. We'll make sure that you don't have any questions about how to reimburse yourself, how to implement that, and make sure that you're not leaving expenses on the table. One that's a little more common is making sure that you have the best entity structure. A lot of times when people set their businesses up, they don't really spend the money on the accountant or anything like that up front, and maybe just go out and set up a corporation or something along those lines. I mean, we're always going to kind of look at your entity structure and make sure that your structuring is such that you're tax advantaged. So that'll be something that we're looking at as well. With the Trump tax plan a couple years ago, there was this 199A deduction, which allowed businesses to receive a 20% deduction off of their business income. And there are income limitations, and if you're in certain types of businesses, there's limitations. And so one of the things that we've done over the past couple of years is really just kind of nail down on bookkeeping and nail down on your numbers to make sure that you're not outside of any of those income limitations and leaving that on the table. So one example, if you're married filing joint, you make $315,000, then you're going to get the 20% deduction off of your business income. If you make more than that, it starts to phase out. So, if you're sitting at $400,000 and there might be some kind of way that we can spend some money and get you down, it may create a 20% tax deduction off of, whatever $200,000 of business income. I mean, that could create a really, really massive tax deduction. So we want to make sure that you're taking advantage of Section 199A in your business. Another one that's come up a lot is reasonable salary. So if you have, I'm talking to all you S Corp owners right now. If you have an S corporation, we try to emphasize this a lot, but it always seems like there's somebody out there that did not pay themselves a salary, didn't understand that they were supposed to pay themselves a reasonable salary in their business. If you're an S corporation, hear me out here. You have to pay yourself a salary. You have to go through W-2. We take a lot of steps to make sure that our clients don't get audited. And I will tell you, the one audit that I had to do this year is because somebody did not pay themselves a reasonable salary. And it's not hard. We connect you with ADP or somebody else that efficiently can take care of your payroll and the quarterly filings, and it really, really does just avoid a headache. So let's make sure that you're taking advantage of this. If you're listening to this and you have an S corporation and you're like, I don't give myself a W-2, I need you to email me right now. I need you to send me an email and say, Ronnie, I'm doing something wrong here. Another good one's hire your kids. If you have kids that are working age, I'm going to emphasize working age, because every year I have somebody that wants to pay their 4-year-old $12,000 because they heard that it's a tax deduction. It is, but it needs to be something that's reasonable. So hiring your kids is a great strategy. If you've got a small business and you want to reduce your tax burden, put your kids to work. you have to put your kids to work in a reasonable way, and kind of keep track of the hours that they're working and what their tasks are, and make sure that it's all reasonable. But you can pay your kids $12,000 up to $12,550 per kid, and totally get a tax deduction for it. You have to treat them like employees, but if they make under the standard deduction, then they don't have any tax burden. So, that's a good one. Usually, like, there's been times where I've had maybe somebody that's in a 30, let's just call it 30% tax bracket. They got 2 or 3 teenagers that, they're funding their lifestyle anyways. And so, they paid them 12 grand a piece. So, this $36,000 that, let's just say 3 kids, 36,000 is 12,000 a piece. They pay them and put them to work, and 36,000 times 30%, they save like 10 grand on their taxes for doing it. So that's a cool strategy if you're in the right situation. Sometimes I have people though that are like, hey, I got like my 4-year-old, and like, they pick up trash around the office. I'm gonna pay him 12 grand. That can be a little bit sketchy. So anyways, that's how I would do that if we were doing that. Now, there is a good code section 280A that allows you to rent your personal residence to your business. Well, really to anybody, but you can rent it to your business for 14 days or less, and you can hold corporate meetings in your home. I'll probably do a separate video to teach people more about how to do this and how to do it the right way. But keep corporate meetings in your personal residence in the back of your head, 14 days or less. You hold a meeting at your house once a month for your business, and you can get a tax deduction for that. So that's one that can be really good. If you have a commercial building, I have a lot of clients who, maybe are renting a commercial space, and maybe decide, well, hey, I'm going to buy a commercial space. And one thing to really look at is something called a cost segregation. A cost segregation where they'll go through your commercial building, break down everything that's in your commercial building between 5, 7, 15, and 39-year assets. And what it does is it really accelerates the depreciation that you would normally take. So, I've had some clients who want to own their building, and what they do is they will do a cost segregation, and usually they get a couple $100,000 in depreciation expense, and it ends up being really good for them. So, a cost segregation is another thing that you could implement. Another one that I'm a big proponent of is retirement plans. It seems like there's a retirement plan out there that fits pretty much every business owner's needs. It could be a simple IRA for a really small company, or it could be a robust, nice 401k plan for a bigger company. So, that's something to totally look out for. But retirement plans, depending on how much you'd like to put away, or how many clients you end up having, employees that you end up having, that could be an option. If you're a 35-40% taxpayer, you may want to max out your 401k and make a company matching contribution. I have some people that put up to $50,000 a year into either SEP IRAs or 401k plans, and they end up getting, if you say 40% on it, that's $20,000 in tax savings to invest in your retirement. So that could be a really good idea if this situation is right. Let's move over into some personal tax ideas. And like I said, I mean, that's kind of business in a nutshell. When we hop on the phone, we're going to get way more in depth. I'm going to probably end up doing a bunch of videos that kind of break these things down one by one, so that if anything did really stand out, you'll be able to kind of get all the I's and T's crossed and dotted and all that sort of stuff taken care of, so that you're compliant and doing it right. But some of you guys have probably heard a lot of this stuff before, but let's jump into some of the personal tax ideas, and this isn't also meant to be all inclusive either. There's going to be other things just depending on your situations. All right, one of my favorites, consider moving to a tax-free state. You know, I would say lots of people have moved from California, Oregon, Oregon, and trying to get away from, you know, some kind of crazy tax situations into better states. I was in Las Vegas for a long time, and we had tons of people from California, you know, flee to Las Vegas for their retirement so that they wouldn't have to pay 10% state tax on their retirement. So, you know, I always kind of joke about that when it gets started, is to live in a tax-free state. Talk a little bit about a Roth IRA conversion. That's one that I've seen a little bit more of over the past couple years. You know, 2020, 2021 were kind of down years. And so in times where there's down years, it really is kind of good to consider kind of moving that traditional IRA money over to a Roth. That way you'd be able to pull it tax-free in retirement, and also grow it tax-free for however long that you plan to grow it for. So a Roth conversion, that makes you pay taxes now, so it's not a tax reduction thing, but if you're in a smaller bracket, it's a good idea to maybe do it. Capital losses. If you have stocks that you're sitting on that you know, are at a loss, maybe it's time to harvest some of those losses. You know, I know the stock market's been up and down, but depending on, you know, different situations, you may have hit a home run on cryptocurrency over the last year, but then, you know, maybe had some stocks that really kind of tanked a little bit. So it may be that time where you say, hey, you know what, I have crypto gains, but I want to offset it with some of my stock losses. So you know, we'll always kind of do a little bit of analysis on stock losses, because gains and losses really, because if you're in a low personal tax bracket, sometimes it's really good to sell off some of your stock as well. So just because long-term capital gains rates when you're married filing joint, if you make less than 80,000 a year, you could sell long-term capital gains at 0%. So, you know, there's some discussion that's out there when it comes to stock sales. Charitable donations are great, but I will also say that you spend $1 to save X percentage, right? So, you know, like if you're in a 15% tax situation, I'm not going to tell you, hey, go spend $1 on a charitable donation so that you could save 15 cents in taxes. But if you give already and you're a believer in giving and to your community, or maybe it's your church or something like that, then charitable donations can really work out. Now, I will say this, you know, the itemized deduction number, the standard deduction number is pretty high now. So, you know, not as many people really itemize their deductions, and they're like, wait a second, I didn't get any benefit for my charitable donations. So you have to exceed the standard deduction, which is $25,800. So your mortgage interest, property taxes, charitable donations, deductible medical expenses, they have to be higher than, you know, let's just say about 25K to be able to start benefiting from that. But I have had some people who have done some interesting things with charitable donations. One thing is, let's say you had Tesla stock and you've been holding Tesla for the past couple of years. Donating appreciated stock to a charity is a total home run. So, you know, I don't know. I have a friend who has $500,000 in gains from Tesla stock right now. He bought it and he's just sat on it for a couple of years now. He has 500K. If he were to donate 10% of it, let's say you want to donate 10% of it, he'd be able to get a $50,000 deduction on his taxes for donating that stock. Even though he only paid, you know, pennies on the dollar for it, right? So the one thing that you would want to do is you want to donate the stock directly to the charity. It's called an in-kind deduction. You don't want to sell it and then donate it, okay? You want to make sure that you end up giving the stock in kind to the charity, and you get a deduction at a fair market value and never pay the tax. So, if you're one of these people that's usually kicking cash to St. Jude's or something like that, step back, hang on to your cash, give 10 shares of Tesla instead, and take your $10,000 deduction. So that's kind of a cool one. Donating appreciated stock. Donation stacking is also good. I mentioned that the standard deduction is pretty high. If you're one of these people that maybe comes in where your mortgage interest, your property taxes, and your normal charitable donations are right around $25,000 every year, then maybe one of those years you don't do the donation. Let's say 2021, I make no donation, but then in 2022 you double donate. So I did this on my own taxes last year, over the last 2 years. 2 years ago I made no charitable donations, but then on January 1st I made all the donations for the prior year. So in 1 year I got the normal $25,000 standard deduction. In the next year I ended up getting a $45,000 itemized deduction. So instead of 25 1 year, 25 the next year, I got 25 in 1 year and 40 in the next year. So I mean, that's kind of a cool little trick where you stack your charitable donations. Another cool charitable situation that's kind of real estate related is called a conservation easement. A conservation easement is a piece of land that gets donated to conservation where nobody would be able to build on it, and the government gives a charitable donation in exchange for saying we're never going to build on it. So typically what happens where if you're the type of person that's going to want to do a conservation easement is going to be somebody that pays 35 to 40% in taxes. What would happen is you would give, let's just say, for round numbers, I'll say you would invest $100,000 into this piece of land, and then when they donate it, which is in the year that you give the money, when they donate it, you end up with say $400,000 charitable deduction, because when they donate it, it's at the fair market value of the property. So you're sitting there with a $400,000 tax write-off, and if you're in the 40% tax bracket, you save $160,000 in taxes for kicking in $100,000 of money in this property. So there's a $60,000 spread there that you ended up saving on taxes by investing in something called a conservation easement. Another charitable thing for some of my older people, who maybe my retirement age people, would be that you can donate your required minimum distributions. It's called a qualified charitable distribution. So you can give directly to a charity some of the required minimum distributions that you're supposed to get from your retirement plans, and you won't pay any tax on it. So that's a really good way. Another thing that has been around for a long time is called a charitable remainder trust. This is really technical. It takes some attorneys to get involved in, and some legitimate number crunching here, but there's definitely an opportunity to create a charitable remainder trust, get a tax deduction, possibly create an income stream from it. I like it as a strategy, but it is very technical and something that we can talk more about. Other minor things that I would say on the personal side was, if you have a high deductible health plan, what you may want to consider, going to a health savings account and putting the numbers are right around $3,600 or $7,200 away for qualified health costs, and you get a deduction for it. But you need a high deductible health plan to use a health savings account. But that's one. If you've got kids in college, I want you to pay attention to college tuition credits. If you have kids and you're paying for dependent care, there is dependent care credits. If you've got an electric vehicle, there's electric vehicle credits. So knowing your credits is really important. Another thing that I've been doing a lot of is kind of tax bracket management. We've been kind of, following some of the tax brackets and making sure that people, stay within the 24% bracket, because you go above that, it jumps up to 32%. So sometimes when we're doing some of our number crunching on some of these different ideas, we want to kind of look at what those brackets are and kind of make sure that we're doing that. If you are high net worth, estate tax strategies are always something that's really vital to kind of look at. Maybe you're making contributions to grandkids 529 plans to reduce your estate and different things like that. Those are things that we would look at for some of our high net worth people. And then if taxes are owed, sometimes there's a couple things that are certain. It's death and taxes. I mean, I'm good at what I do, but sometimes we pay tax, and our job is to make sure that we minimize that as much as possible. And so, I wouldn't want you to have any unnecessary penalties. Now, sometimes you have to pay your taxes throughout the year. If you have to pay quarterly taxes, the IRS wants their money throughout the year. And so there'll be small penalties on not paying estimated taxes. So if you're the type of person, and it seems like I always have this, there's somebody that doesn't want to pay any penalties at all, we would want to make sure that you're making the proper estimated taxes before the end of the year. So that's kind of a little bit of a laundry list of some personal tax ideas. I will say one of the things that is a little bit hard about tax planning is the political ramifications of what's going to happen between now and the end of the year. I mean, we're going to start doing a lot of these calls and start talking through a lot of this stuff, but one thing that I think is really pressing right now is some of the discussion about what's going to happen with capital gains. We're going to want to watch that, because there's going to be, if they make a big jump on capital gains rates and say, hey, we're not at 15 or 20% anymore, we're jumping those up to ordinary rates. Right now they're saying that it's only going to be for people who are over $1 million, which, okay, I mean, that's going to affect a small percentage of people, but let's watch that stuff, because there might be, I know I have people who are already talking about wanting to liquidate their capital gains. So anyways, that's just going to be some other stuff that we're going to want to look through and make sure that we understand. But let's stay tuned to what Congress is doing right now. And if there's things that you don't like, make sure that you write your senators. I know there's definitely some stuff that I've written my Congress people about when it came to some of the bills that were out there. So be sure to kind of keep your ear to the ground on some of that stuff. So will I, and we'll make sure that you're all taken care of. But if you want to schedule tax planning with me, feel free to reach out on email. I already started plugging people into my calendar. I would love to talk with you and make sure that we have all our ducks in a row. So anyways, really appreciate you guys. And if you have any questions on this, let me know. But thank you for listening. I think this will make our tax planning calls way more efficient. Thanks so much.